Of course, on the West Coast, it's still morning, so good morning to the West Coast. Good afternoon to everybody else. In this video, I'm just going to continue on talking about this recession. I think it's probably the biggest deal that's going on right now within the news is everybody wants to know when there's going to be the interest rate cuts. Like, when is the Federal Reserve going to be cutting interest rates in the future so that everybody can go out and buy a house again, or, be able to afford the loans or pay off their debts or whatever it is that they are wanting to do with the lower of interest rates or the lowering of interest rates. However, I am under the belief that we will not be seeing a cutting of the interest rates until we see a rise in unemployment. Now, the Federal Reserve and their Fed funds rate, that's their ammunition. Like, why would they give up their ammunition if they can hold on to it without causing the unemployment to rise? Because the worst part of a recession is everybody losing their jobs. But as you look down in the link of this description of this video, you're going to find a couple of articles, one of them talking about how the unemployment isn't rising significantly as of yet, even though we have a bunch of layoffs happening within the economy. And this is something that I had predicted. I left a link to a video that I did back in November of 2022. All right, so we're talking almost a year and a half ago. And in that video, I described exactly what it is that I feel was going to be taking place into the future and what we are probably going to be experiencing here now and going on. And that is that the Federal Reserve doesn't have these same issues with the rise of unemployment during the time of when they were in a restrictive position. Now, I know this is probably really difficult for a lot of people to wrap their heads around if you're new to economics, but for those of you who follow the Federal Reserve, follow interest rates, when the Federal Reserve goes and raises interest rates, this makes it very difficult for everybody out there in the economy to borrow money and then participate in the economy with that borrowed money. When that happens, there's a slowdown in business activity, and generally there is a rise of unemployment. Now, we are not quite experiencing that rise in unemployment like we did in the past when the Federal Reserve would raise rates. And this is very confusing for a lot of people out there, especially your traditional old school economist, who would have anticipated by now we would have seen that rise of unemployment, and then therefore the Federal Reserve would have to lower interest rates in order to achieve their dual mandate, which is full employment and low and stable prices. So right now, their whole goal is low and stable prices because the unemployment isn't rising. They're not necessarily concerned about that as far as bringing interest rates down to achieve that dual mandate. Does that kind of make sense? So as long as the interest rates stay elevated and the unemployment doesn't rise because of it, then they're only focused in on prices. And so this is really where the Federal Reserve is positioned right now. Everybody anticipates that they're going to be lowering rates because of achievement of the 2% inflation or something like that. But in my opinion, it was just like, well, if they're achieving their 2% inflation and the unemployment doesn't rise, why would they even need to cut? Like, what would be the point of it? Like, they've achieved both dual mandates, or both sides of their dual mandate. There wouldn't be any need to cut rates at all. So how come there isn't this rise in unemployment? Like, what happened? Like, typically you would see that. Well, you have to think all the way back to the pandemic. And during that time, when the pandemic was kicking in, there was a lot of stimulus packages being handed out. Part of the stimulus packages was the setting up of the special purpose vehicles. Now, this was entities that were separated from the Fed and the Treasury. Now, typically, they would not be able to use these facilities unless it was an unusual and exigent circumstance, right? So the unusual and exigent circumstance that then gave the ability of the Federal Reserve and Treasury to set up these special purpose vehicles in order to backstop the entire financial market. And part of that was the corporate debt lending facilities. Or the corporate debt lending facility. With this corporate debt lending facility, they were going to be buying up corporate debt. This whole idea of buying corporate debt then had the markets going, whoa, wait a minute, the Federal Reserve is going to be buying corporate debt. We could buy corporate debt now, knowing that we can offload this corporate debt to the Federal Reserve since they are promising to be buying it with the special purpose vehicle. And they have $600 billion. I forget, it was hundreds of billions of dollars. I forget the exact number, but it was a lot of money that they had put up for the purchasing of corporate debt. Now, everybody flipped out, and I was one of them, right? I was saying, man, the Federal Reserve is going to be picking the winners and losers. Turns out they bought a little bit of corporate debt to establish that credible threat, but really the market stepped in and provided the funding to all these corporations, really, and the Fed didn't have to do anything. They just sat back and watched it happen as the market itself started buying into the corporate debt, thinking that they would be able to front run the Federal Reserve and sell it off to the Fed, or at least have an outlet for the purchasing of their debts that they had purchased from the corporations. So now the corporations are sitting in a position during the pandemic in which that yields, like the interest rates that they were paying on these bonds, fell dramatically. Like they were able to sell the bonds for a really high price and take out a really low interest payment on it. So all these corporations were just gorging on incredibly cheap debt. So when you're gorging on this incredibly cheap debt, you have to do something with the money, right? So what were these corporations going to do? They're going to expand their operations, more buildings, more equipment, hiring people, right? So all of a sudden there's this huge demand for labor, and they all started moving up into like these zombie corporations who started eating into like all these resources, all the best talent, all the people. And they started hiring all these people, which left the service industries without anybody to work, right? And so you're wondering why all these restaurant workers, all the bar workers, everybody who was doing these service industries, all of a sudden left the workforce. Well, this is one of the reasons why. Now, there is a lot of other reasons out there, people retiring early, lack of schooling, there's people just simply passed away. I mean, there was all like dropped out of the workforce. There was all kinds of reasons behind it. But I called this out a long time ago. And this is what we're now experiencing, right? The layoffs that are happening within the zombie corporations, and people are moving over into those service industry jobs. Now, it's not a great job, but it's a job. And if you have a job, you're not unemployed. And so this is really what we have taken place as the recession is kicking in, right? Which would typically cause unemployment to rise. We were coming into the recession pre-bailed out. Like the corporations had already been bailed out during the pandemic. A lot of people don't realize that these corporations were sitting on an insane amount of cash right now. Like the ones that aren't failing, the zombie corporations who are failing, those people are getting laid off. The people who are getting laid off are going fine and work at the service industries, but the corporations who are viable are sitting on a ton of cash. Take a look at the link I leave down in the description. There's a Harvard Business Review article that totally goes into the explanation of why these corporations are sitting on all this cash, even though the Uneducated Economist called it out a year and a half ago that they would be sitting on cash going into the recession, knowing that they would have to have something on hand in order to make their payments, considering that the yields were going to rise and rolling over their old debt into new debt wasn't going to be exactly easy for them to do. So if you're a corporation who is going to go, knowing that there's going to be a recession or at least some sort of downturn going into the future, and rolling your old debt over into new debt was going to mean that the interest rates are going to be much higher and you would have to make higher payments. A lot of these corporations ended up just holding on to that cash. Like they took it all out during the pandemic and they just sat on it the entire time. And now here they are going into bad times, but yet they have the cash in order to continue to make their payments. Those who can't fail, go out of business, lay all their people off. And this is the situation that we are now in. So this is like the recessionless recession. I mean, I've called it out a long time ago. It's playing out pretty much how I thought it was going to. And a lot of people aren't explaining it in this fashion. Like they don't even realize how much of a bailout took place, like that pre-loaded bailout that had happened during the pandemic. And now we are experiencing the effects from that. All right, 9 minutes into it. I think this was good. I like to get the 10 minutes out, like a good 10 minutes of information before we start going into the comments, because I know a lot of people really don't have time to sit through an entire live stream. So they really just want to get the information and get out. So that's why I do the 10 minutes, and then we'll go through and looking at some of these comments here. All right, UE, let's go. Hello, good morning, Simon. Can deflation hurt an economy? Yeah, it really depends on the position that you are in. Is deflation a bad thing? Is it a good thing? It doesn't really matter. It's not a good or a bad thing. It's like the weather, is rain bad? Is sun bad? I mean, and who knows? Like, it's just like, it's all about the position that you have taken, for yourself. So a deflationary scenario is really awesome for savers. Like anybody who had saved a bunch of money or has, God, I got this hair hanging down. I don't know. Anyway, anybody who is a saver, anybody who has been, saving, whether even if it's in like treasuries or money markets or anything, when a deflationary scenario happens, everything is going on sale. So, like, that's an awesome position for anybody who is a saver. However, if you are somebody who is heavily in debt, or you're somebody who is, in business, so like, you're doing retail sales or something of that fashion, well, then deflation is a very difficult thing to operate in because you have less business. It's more difficult to make your debt payments. You come into a situation in which it's very painful to operate in. So it's just about the position that you have taken. Now, whether or not it's a good or bad thing, it it's neither. It's neither good or bad. All right. Pouring up here in Washington. Looks like you get sun. Lucky. Yeah, for the moment. It was dumping pretty good earlier, so. Alrighty, all-nighter. Hey, everyone. So, neither for the long term. Colin 11. Hello, all-nighter. Looking forward to seeing how your project comes out. Yeah, me too. He's got some great videos showing the progress on it. So I would suggest everybody go and take a look at All-Nighter's YouTube channel. He's rebuilding a house right now. All right, dishes every day has the smiley face. Dishes, all right. Rates stay paused, then raised. No rate cuts this year. Hey, all-nighter, we may have to get you to come down to Alabama and work on some projects. Hey, there you go, all-nighter. Hello, everyone. Hey, do you think the stock market is going down? I don't know. I mean, it's hard to predict where the stock market is going to go. I I mean, like, nobody knows if it's going to go up, down, or sideways. Like cryptocurrencies, everybody has these predictions of, like, Bitcoin going to like $150 a piece or something of that fashion. I mean, it would be awesome if it did, but am I terribly excited about that idea? Not really, because I just don't, I mean, it's too volatile for me to put any kind of hope into it like that. So I don't know. I just dollar cost average into the stocks. I buy my positions. I have my little stock portfolio that I'm working on. Coinbase is killing it. Like, it's by far the biggest position that I've had, even though it's like the least amount of money that I've invested into any part of my stock portfolio. But as far as going up, down, or sideways, I think, really it's more a matter of like the position that you have taken again with the stocks that you have picked. I mean, you know, I don't know. All right. Ain't confusing. Really tired of a financed economy. No loans. Prices should come down. But if the rich can't sell you something, they will buy up everything to sell you when they can loan you money. Yeah. And, a kind of a good way to look at that is like, like kind of like gardening, almost like when you garden, you have to till the land up. It looks like hell. You plant all these seeds, you get these little starts going, and it takes a while, but eventually, I gotta put some sun shield here. And eventually you get the plants to grow. Well, as time goes on, you get these big, beautiful plants, and everybody just talks about how awesome the garden is, and everything is really getting to the point of being ripe and ready to pluck and harvest. And then you go through and you harvest everything out of the garden, and it just looks like hell, right? Well, and then you got to till it all in again and start over, right? Well, that's a lot like the debt cycles. When you go through a recession, that's like the tilling of the garden. It's getting rid of all the bad stuff, all the bad undergrowth, all the malinvestments, all the crap that's out there. And then you start with like the bare minimum that you have, right? Well, then the debt issuance, those are like the seeds. That's like sowing the seeds out there is when you put this debt issuance. So all of a sudden, all this debt starts flooding out there into the economy, and people start grabbing a hold of this debt and start building beautiful things. They're buying beautiful cars, they're building beautiful homes and buildings and businesses and stuff. And then they get it all the way to the point where it's now at its peak, right? Well, then it's time to turn the debt off and go into harvest again. So as people fail to make their debt payments, all these beautiful things that they had built, all the houses, all the businesses, all the stuff out there is now unavailable or is now going into default. They're unable to make the payments, but now these things are available to those who have cash, right? So this is the harvest season for the rich. They planted all the seeds, all the debt. The people who borrowed that debt built beautiful things. Now they can't afford to get them, and the rich come in there and basically pick it up for pennies on the dollar, right? So if you kind of understand how this cycle works and how the rich use that, well, then you try to position yourself as best you can to not fall victim to the harvest, right? And that's the recession, is that harvest period. So it will come, and it may not be in the way that we once remember, because like typically you would lose your job in order for the harvest to begin, right? In order for them to start going in there. But now it's more of like you're just not going to be able to afford the standard of living, and so you'll just naturally, even though you don't lose your job, you just won't be able to, afford to eat. So therefore, you won't make your payments, and that way you'll lose your stuff and get harvested against. Does that make sense? God, what a weird analogy. All right, moving on. I finally caught one of your streams. Thanks for all the intel, brother. God bless you and yours. Well, thank you very much. Not a pilot. I really appreciate the comment. You called it, Wayne. I'm putting my tools down now. What did Wayne say? Oh, safety meeting. Yeah. All right. Have tools, will travel, Dennis. All right. Early career software engineer here. I agree with Simon and would add the following. High interest rates equal harder for tech companies to have cash on hand to hire more junior engineers. Yeah. 2, lots of FANG layoffs last year and dumped high volumes of engineers with prestigious recent experience into the market. Yeah. And so this is like, again, like, one of the problems when you run into like expansions, like when you have a lot of stuff that's happening in the tech, like we had, all of a sudden everybody's talking about tech, right? And now these companies, they emerge and they're like, hey, we got this idea for, a particular, particular idea, right? As far as what's going to be advancing into this technology. So you have these companies that are saying, hey, we got these products that we're going to put out there. And you say like you got 5 companies that all have something similar to each other. Not all of them are going to make it. Like there's not enough room for all 5 of them to make it. Right? But you're an investor who wants to invest into this particular form of technology, and you're not sure which one of these companies is actually going to make it. Like you got a couple that are probably going to do okay. 2 of them are going to fail. One of them might, actually kick ass at it. So what the investor does is, because he doesn't know exactly which one of those companies is going to kick it, going to do well, he'll invest in all 5 of them, right? Knowing that 2 of them are going to fail, 2 of them will do okay, and one of them is just going to do really well. So this is where a lot of these zombie corporations end up emerging through like the investment community out there looking to invest into a particular technology, but there's just simply not enough room for all of them to exist. But they can all rise together while the money is flowing. But as soon as it churns off, only the most viable companies will actually stay, where the rest of them end up failing. And this is why you're seeing so many layoffs within that industry. I mean, at least this is the belief that I have, and from the things that I have seen going on within the economy. All right. 3, tech companies don't want to take a chance on more junior, less experienced engineers and prefer are hiring senior level positions that are more guaranteed. I feel laid off without being laid off. If I lose my job, I would inevitably fill a service sector role to keep paying the bills. It's not true. It's not true unemployment, but it's certainly underemployment. You're right, Simon. Yeah, absolutely. And I mean, that's just the case. That's the case for everyone, I mean, I would do like even I myself would do it, if I was to get, laid off. Okay, I gotta run now, pick someone up. We'll try to be back. Maybe this was a warning. All right, all-nighter, we will talk soon and may plan something in the near future. I'll finish with Gary first. Deja, why are property taxes based on assessment, which varies greatly with an appraisal value? I don't know. Like, luckily, like in my area, the taxes can, there's a certain amount that can only go up, and they won't go up any more than that, but limited. But I don't know. Like the way they do taxes on property is just crazy. I mean, there was somebody who was telling me one time about like how much they pay in taxes, and I'm like, holy crap, that's more than like my house payment, It was like, how in the world do you end up paying that much? Hello, my fairly educated friends. Right on. Underemployment is way better than unemployment. Yeah. Please explain the business cycle more. Well, I mean, the business cycle, I think the business cycle was easier to understand when we had a fixed currency, like with gold or something. And it made it a lot easier to understand how come you would have business cycles. Like the business cycle still exists, but it's a lot difficult. It's more difficult to see it, considering that it's more covered up by a debt cycle that we now experience with the fiat currency. But when we had a fixed currency, like when we were sitting on the gold standard, it makes a lot more sense to understand the business cycle with the gold standard. And like really, if you take on Cantillon effect, it really starts to make sense, right? So like if you can imagine that you're in a, just take it, you like your community, your little, your little area, and there's not a lot of people who come and go from your community. It's just your community, right? And there's a certain amount of gold that is now floating through the community for money, right? We all transact with each other and we all kind of share the currency together, but there's only so much of it there. Now you might have some that comes and some that goes through, import exports or whatever, tourists coming in and dropping money off, or maybe, business leaving for whatever reason. But if you can just imagine that you got your little community, you got your fixed amount of currency that's within it. Now, if you have a particular business person who is within that community who is doing really well, and they start like saving their money, right? They don't want to spend it, they don't want to reinvest it, they just want to hold on to it. But they're doing a lot of business. Well, as they're starting to save their money, what they are doing is they're pulling the amount of currency that is available for other people out there within your community, because it's all being concentrated into the hands of just one of the individual, right? Or maybe it's just a couple of people out there who are doing this. Well, as they start to deprive the rest of the community for currency, now they're having trouble trying to figure out how it is that they can conduct business, right? Somebody might say, hey, I have a business cleaning houses. How would you like your house cleaned? I can offer you a really good deal. This is like, hey, I would really like to, but I don't have any money because nobody's buying the products that I am selling, because nobody else out there has any money either, because it's all being held by a handful of people who had done a lot of business and had saved all this money. Well, now they're suffering for, these people who had collected all the money. Now they're going to end up suffering in a position in which that they are going to have to relinquish that money. All right, because the rest of the people out there are no longer able to function in the way that they once did. They're not going to be providing the goods and services out there that everybody had once enjoyed, because there's simply no money out there to conduct business with. So the people who have hoarded onto it are going to have to start relinquishing that, right? And in order to get the goods and services that they want, there's no point in having this money if you can't buy anything with it. So what ends up happening is because their business is now slowing down, they're unable to get the new money coming in. They have to maintain their standard of life. So they start unloading that money back out there to the people, which starts the business cycle over again. So this is probably one of the simplest, explanations of the business cycle. But if you can understand it in that fashion and kind of incorporate the Cantillon effect with it, it makes a lot more sense on how this business cycle ends up working. When you have fiat currency, that moment that it should be redistributed back out there to the people, they don't, right? You get a short recessionary period in which that everybody starts suffering with unemployment rising and stuff like that, but then the new debt issuance comes out, all this new money starts to pour in, and then you have the rich separating themselves from the poor. And so the fiat currency, the debt cycles, although it does take a lot of people out and clears out a lot of bad undergrowth or malinvestment, so to speak, what it ends up doing is once the new money comes in, those who didn't fail separate themselves even further from the poor or from the lower class, or the inequality starts to grow. All right. Okay, guys, I have about another 5-10 minutes here, and then I'm going to have to call it quits. All right. Politicians aren't going to revitalize anything unless it is their best interest. It's up to you and I to make the correct decisions with the given administration. That's exactly right. I lied. Haven't dropped my tools yet. 5 minutes and I will. Administrations are just the present plantation overseers. If you tell them there is no renovation or improvement, that's the tactics I use. Simon, can you explain the Cantillon effect where YouTube is the silver mine? Do you see similarities to what you discuss? Do the same rules apply? Simon, can you explain Cantillon effect where YouTube is the silver mine? Do you see the similarities to what you discussed? Do the same rules apply? Well, okay, so I mean, are you thinking like, because like, just for an example, I'm on YouTube, I put out videos and the ad revenue is like this, like the silver mine, and so I have money now and now I get to spend that money into the community, so like YouTube is the silver mine kind of aspect of things. I mean, I guess one could say that, but that's a very isolated to the individual, right? I mean, that's not like the broad economy where everybody jumps on YouTube and can get new money coming in from the YouTube revenue. I mean, anybody could do that, but not everybody does. And generally, most of the new money is coming in through debt issuance. So people who have first access to the money are the people who are taking out debt first. And the people who are taking out debt and then buying assets that then pay them and pay the debts off, those are the people who are using good debt to separate themselves from everybody else. So like the silver mine is not YouTube. The silver mine would be debt issuance, right? And that's where the new money comes from. Because it filters eventually through YouTube, and then to me, it's still the debt issuance that is creating, that would be the Cantillon effect, or the new money coming in placement of the silver mine. But as far as like the individual, like, you know, like myself using YouTube, I mean, that's not necessarily part of the Cantillon effect, because I'm not getting new money coming in. I'm getting advertiser money, right? I have to go and work for it. I'm not the guy who's like getting the money first, right? I'm the one of the dudes who's down below there, who is now, you know, basically being trickled upon, right? And then eventually it goes down to the rest of the people. So it's not, YouTube wouldn't be considered the new money. It would be the debt issuance that would be the new money. Now, say an advertising company or something like that, let's just say for an example, was to take out a bunch of money and then use that money to then start advertising on YouTube, and I was able to get some of that. Yeah, I have kind of first access to it because I'm up there towards the top, but I'm still like in line, right? Not the very first one, who is really the people who get to spend that money at face value. I'm in the same position as everybody else is that once I get it, then I have to, you know, suffer with the higher prices as like the same as everybody else does. So really, to be in that equation, you really have to be the person who's taking out the debt first and then spending that money. All right, the Fed always steps in to assure those that fail get more chances to fail. $6,000 a year here in property alone, county. Oh man, county borough, is that what it is? I looked at 30-year tax data on my property, and only 1 year the tax decreased. I think it was 1 year in 1980s. UE, you should write a book about the Federal Reserve, explaining it easier for other people. Yeah, I consider that. I mean, that's going to be part of the course that I do as well. Like, I'm still, you know, getting these preliminary ideas of what it is that I need to do for this course, but I'm building them up. Like, I got the ideas, and when I get this thing done, I want it to be good. Like, I want it to be like seriously good, you know? Not just something I threw together so I could try and sell it. I want something that is going to be like lasting. Like I was taught, America isn't a country, it's a business. Yeah. All right, I'm back. Right on. Okay, we've tried this current administration, but it's hard to work around $15 minimum wage, and no one is encouraging to go to work. Yeah. I don't know. We tried this. Oh, yeah, we already did that one. Alrighty, Bentley. So, anyway, we're about 30 minutes into this. I think that's probably good for this live stream. I really appreciate everybody joining in. We got 219 people watching right now with 62 likes. Do me a favor, go hit that like button before we end the live stream. YouTube loves it when they see a lot more likes on the live stream, and then they take the video and go spread it around for more people to see after we get it uploaded. Thank you, everybody who has hit the link for the Amazon affiliate sales, the associate sales. It's done quite well. I'm actually getting a few commission dollars off of those purchases that you are making. You don't have to buy the Cantillon essay. You can just click on that link, and anything you put in the shopping cart for the next 24 hours, I get a little commission off of that. So yeah, if you're going to be making any kind of Amazon purchases, just go hit that link before you go shopping, and you know, the Uneducated Economist will get a little bit of credit for that. So thank you very much for doing that. Thank you everybody who's joined the membership too. We've had quite a few people who have joined the membership over the last couple of weeks here. And although I was doing a membership only video over the weekend, I forgot to make it a members only video. So it ended up going out with the public as far as that live stream goes. But still, I think it was a really good video. It was very informative when it comes to like the Federal Reserve's understanding, or at least the position that they are looking at the interest rate cuts due to the unemployment rising or not rising. It was a really good speech that we broke down and had a pretty good discussion about it. So if you haven't caught that yet, maybe go check that one out. And I don't know, I guess that's it. All right, Uneducated Economist, you guys let me know. Thanks for going and hitting that like button.